Vice Chairman C. Anurag Chaturvedi for giving your budget review. It was really something different we learned today. And now I think I would like to invite CA Jayaprakash Agarwal because our next speaker, CA Ved Jain, is already live now. And as per the circular sent to you guys, actually CA Dr. Giri Sahuja was supposed to join, but due to some unavoidable circumstances, he is not able to join. And then we contacted CA Ved Jain and he agreed at such a short notice. So thank you very much. Ved Jain Saab, I think you are hearing us. Now I would like to request our ExCom member CA Jayaprakash Agarwal for his introduction. Over to you, sir.
सर मूवी में शाहरुख खान हो या सलमान खान हो, मूवी ब्लॉकबस्टर रहती है. सो इट्स आइदर गिरीश आहूजा और सीए वेद जैन. द एनालिसिस विल बी परफेक्ट. What we want to understand from CA Ved Jain is, we understood market is bullish about capital, you will get your income. The thing is whether that income will be earned by you or you will be giving away by taxes. Though I have not seen major changes in taxes, but obviously Guru is always Guru and he will tell us how exactly taxes has evolved in this budget. CA Ved Jain has been a man of prudence, veracity and intelligence since birth. Academically, he is brilliant. He is a rank holder both in CA Inter and CA Final. A triple bachelor. I mean, I was struggling to complete one bachelor. He completed triple bachelor degree, one in science, one in economics, and one more in Bachelor of Law. 3 bachelor degree. He has a prolific writer, having command in Hindi, English, French, Urdu, and Punjabi. I struggle only in 2 languages. He has 5 languages command. He has written and authored many direct taxes books, regularly contributing articles on tax matters in various journals, newspapers, and frequently participates in various television programs on finance, taxation, economy, and related subjects. He is director of the board of DLF Limited, Inventia Healthcare Limited, Chairman MCX Clearing Corporation Limited. His integrity, zeal, and commitment towards society have been recognized and appreciated by the Government of India. He was appointed as Government Nominee Director on the board of Mehta's Infra Limited and Mehta's Properties Limited post Satyam episode to manage these companies, which he has not only been able to manage but revive successfully. He is being regularly consulted and member of various expert committees, panel constituted by the Government of India. He is involved in banking, capital market, accounting, taxation, corporate laws, practicing professional with specialization and direct taxes, and I still have 5 more paragraphs to go. Sir, I will skip there. I mean, it's a long profile. I will hand it over to you to understand how exactly we will benefit from taxes, whether we are getting our income back from the investment or whether we have to pay it to the government. Ved Jain Saab, on the screen. Beautiful smile.
Thank you, sir. Thank you. Thank you for that introduction and thank you for your compliments. To answer your question first, my dear friends all in Dubai, I'm sorry I joined a little late. I had a commitment again already with IBPC today. I just got free and I joined the program this today. My best wishes to all my friends and my professional colleagues in Dubai. My topic is taxation, and he has rightly posed a question whether we are going to pay taxes more or we are going to get something more from the finance minister. I believe this is the normal human cry before the budget is presented. Okay, that when the finance minister, everybody says, reduce taxes, give me more concession, more exemption, more reduction, etc. But the finance minister was kind enough and bold enough, I will say, to say no to everybody, no concession, no benefit, but no taxation. This gives you an idea. If you have a glass half filled, you may feel that it is half filled. Others may say, no, it is half empty. Those who say that they have not been given concession, but at the same time, there are many who say they have not been taxed. Last 2 years have been quite difficult for the economy. There have been lockdown, there have been health issues, there have been economic issues, and there could have been a challenge to pose extra tax, extra surcharge, cess to meet the corona crisis, to meet the deficit arising on account of it. But she was bold enough not to put any taxes last year and this year also. So friend, I believe that's a good news. Stability to the tax regime which she has given, and stability. And wherever there were few irritants which she has taken care of. One of the irritant which I believe you may also be interested was that whatever the investment you make and when you sell it out, so there is a tax on the long-term capital gain which you earn, and the surcharge was too high at 37%. which she has now reduced to 15%. If you are holding any investment in securities in India or any long-term asset, please don't make sure that you don't sell it before 31st March. If you sell it after 1st April 2022 and your income is more than 2 crore or more than 5 crore, still the surcharge will be 15%, not 25 and 37%, which is the benefit which she has given on that point. Another benefit which for the known, I think I'm speaking from the perspective for which you may be interested. You all know about the Gift City at Ahmedabad, which is being developing at the financial center, and we have international financing center there. So big concessions have been announced for non-resident. Now you can have a portfolio there, and whatever the income you have from that portfolio or derivative, etc., that will be completely exempt in your hand. And you being a resident of UAE, you have a double advantage that you need not pay tax in India and also in your home country. Other countries' residents have a challenge that even if you earn any exempt income from any part of the world, but you when take back to your home country, you become taxable. But in this case, it will not be taxable. Now, you may have a question that about your residential status because of the amendment made last year that about stay in India for 120 days or 182 days or more. I may just clarify one issue. India has a treaty with UAE. If a person has been in UAE physically for 183 days or more, he will be a non-resident for India. He will be a resident for UAE under the UAE law. And if he becomes a resident of UAE under the UAE law, then obviously under a treaty, under a tiebreaker, he will be considered to be a resident of UAE and not a resident of India. And you will be eligible for all the benefit of the treaty of including exempt income, which you earn, also a concessional rate of tax of investment, which you have made outside the gift city. Gift city, you will be fully exempt, but in India, whatever you made, that dividend income will be taxable at the rate of 10%. So there are various exemptions which have been announced for the gift city. If you have an income of leasing, royalty, or you have another income from that income will be exempt income from the gift city. So that's the additional advantage which she has both. Now, this budget has given another, I think, thing to ponder over is stability to the tax regime. Sometimes it looks attractive to get concession to have a tax reduced, but at the same time, when you have more concession or you get more exemption reduction, it also lead to instability in the tax regime. But this time, in the last 3 years, it has been proved that yes, there will be stability in the tax regime. India continues to be, I believe, at the lowest tax rate. As a corporate, 15% tax rate is the lowest globally. I believe all of you professionals may be knowing and your experience. And this will be more attractive now looking to the 9% tax, corporate tax, which is going to be introduced in UAE from next year onwards. So that, I believe that also makes it a little bit competitive as compared to UAE. Not 9%, but 15%. So that's an additional advantage. Now, as a proactive measure, you would have heard, but I think you would have watched on the television also, that on cryptocurrency, a tax at the rate of 30% has been imposed. Now, this sends two messages. One, stability and clearness in the taxation. Otherwise, there would have been litigation at what rate the tax should be applicable, whether it is a capital gain or a business income or income from other sources. I believe this budget has settled that controversy at rest, irrespective of the nature of income, whether you consider it a capital gain, business income, or income from other sources. This is going to be taxed at the 30%, and with, of course, applicable surcharge and education cess. So this is just like prize winning, horse race winning, or like gambling, etc. 30%, and any person who is a resident of India but need to take care of other provisions. Some people have asked this question whether it legalize the investment in cryptocurrencies. My answer will be no. This is neither no, neither yes. But coming from the mouth of the finance minister and without raising the issue of illegality, I will say tacitly yes. It says it has been legalized that way. It is a tacitly that I can say on that part. There are other provisions in the income tax which you may not be interested on that aspect, but there are something which has to be, which may be relevant for that purpose. One, that now India has a complete faceless assessment procedure, and that has been completely revamped with complete natural justice, complete availability of video conferencing facility that has been given. an additional window has been opened for those who have not been able to file the return or who have filed the return and later on notices that there is some inaccuracy in that return. They can update their return within a period of 2 years from the end of the relevant assessment year, which virtually means 3 years period availability from the close of the financial year that you can update it, but of course by paying additional tax of 25% if it is within 1 year and 50% if it is paid beyond 2 years. So that's the additional advantage which has been worked out on this issue. Some of you probably may be interested in knowing some provision regarding the charitable institution trust, because you though may settle in UAE, but maybe having some back in India connected with some NGOs, etc. So there is a totally revamp of those provisions. I suggest that those provisions have been made a little bit more difficult, but compliance-wise, I will say yes, there may be challenges, but government finds that charitable institution, particularly engineering colleges, medical, hospital, etc., they are some way misusing this provision. So I believe over a period, there has been a change on this issue. Good news on the business side, that startup now which period was expiring on 31st March 22, the period has been extended by 1 year. You can set up a new company still by 31st March 23, and that still can take the benefit of the startup exemption, which is available under Section 80 IC. Similarly, now for manufacturing company, the rate is 15%, as I said earlier. So that year, 1 year provision has been extended. So you can add additional benefit of 1 year. So now up to 31st March 24, you can set up a company and put manufacturing or production in line before 31st March. Then you will continue to have the benefit of a tax rate of 15% on that part also. Now, there are other provisions which probably I think may not be of much interest to it. If there are a few questions, or I can take up on that part, but otherwise, I over to the, I think, the hosts, please.
I think we don't have any questions from the audience.
Any topic which, because I have not touched upon the nitty-gritties of tax provisions, probably may not be of much interest to you sitting in Dubai. But if there is something like dividend stripping on the issue or other issues of assessment, which I can take.
Yeah, any kind of discussions to make the session interactive. So it's a good opportunity, guys. Yeah. Yes, we have one.
Amit, till the time you go there, I can see one question on the Zoom. Sir, the question is, and it's also available on your screen. It says, please explain the bonus stripping provision. Bonus stripping.
I will just say, there is a provision under Section 94(7), which was introduced mainly for mutual funds, and particularly debt mutual fund. What used to happen is that when you buy a unit, which is having a basic value of 10 rupees and going up to 20 rupees after accumulated profit, and it declares a dividend, and then you sell that after the declaration of dividend, the value of that unit, what we call net asset value, comes from, say, if you have declared 10% dividend from 20 rupees to 18 rupees, and then in 2 rupees, you sell that unit at 18 rupees, so you were able to make a loss because you have bought at 20 rupees, sold at 18 rupees, and your dividend income of 2 rupees used to be exempt. So this is used to be called a dividend stripping, that without losing money, you get an exempt income, but at the same time, you are getting a loss which you are able to set off against other income. So that provision was introduced for mutual funds and also for dividend stripping. Now, India introduced 3 years back REITs, which is the investment, or InvITs, real estate investment trust, where these units are also being sold, and you can have a dividend stripping type of income which can be stripped up. Now, in order to address this issue, this section 94(8) is being amended to provide that in case if you buy a share or security, which means security, which will include equity share, units of the REITs or a units of mutual fund, within a period of before 3 months before the date of closure, what we call fixed date for declaring bonus, etc. And you sell that in the next 9 months. And in between, because of the book closing, you have made a loss out of it. And at the same time, you have got a bonus out of it. Now, to the extent that loss will not be allowed. If I make out an example like this, you have bought share of Reliance Industry at 2,500 rupees today. And the Reliance Industries declares bonus 1 for 1. And that bonus is suppose date of what we call book closure is 31st March 2022. And you bought it today. And on 2nd April or 4th April, the rate will become to 1,250 rupees. And if you sell this unit or a share of 2,500 rupees on 2nd April, obviously there will be a loss of 1,250 rupees normally. But in between, you have got this bonus share at a zero value. So now the law says that this 1,250 rupees loss will not be allowed. This will be considered to be your cost of the bonus share. So this is called dividend bonus stripping, which will be prohibited from 1st April 2022.
Thank you, Ved Jain sir. Thank you for your insights. We would like to hear more about the Gift City with respect to the NRI exemptions.
Yes, please. See, there are 4 exemptions which has been announced. If you look at the Income Tax Act, Section 10, as you all may be knowing, is a section for which says income which is not considered to be income. Now, India has promoted this gift city on the line of what Dubai and on the line of Singapore. The basic idea was to make it a financial hub of the world, whereby you can do trading business like what you can do globally without being bound by any tax law or any other fiscal law of India, except law and order which is applicable to that part. You can do any activity there. Now, if you do any business or activity there in that financial center, you are not liable for any stamp duty, you are not liable for STT, you are not liable for any income tax, etc. Years after year, now new activity are being exempt. 2 years back, what has been done, India has said if any bank set up a unit there, what we call offshore banking unit, because India considered a gift city as an offshore. It is not onshore, it is a country outside India like this. If you set up a banking unit there, whatever the income you make from there, now that income will be exempt. Now, for many international banks have set up their unit there, what is called offshore banking unit, or Indian banks have also set up unit there. Now, you can borrow fund, you can lend money from there, and whatever the margin, NIM, what we call net interest margin or bank margin, you make profit, that is exempt. Now, in line with that, this budget has also announced 4 exemptions. In case you transfer any offshore derivatives instrument or over-the-counter derivative entered into with an offshore unit, that whatever the income you are getting out of that, that will not be taxable. Similarly, exemption is being extended to non-resident by way of royalty or interest on account of lease of a ship in a previous year paid by a unit of an international financial services unit. So if there is a leasing being done through a offshore banking unit there, income which you get because of the lease on account of interest or royalty, because sometimes that is considered to be a royalty, so that will also be allowed. Now, ship will also include this aircraft, ocean vessel, helicopter, and the parts thereof also. Similarly, income received by a non-resident from portfolio of securities or financial products or funds managed or administered by any portfolio manager on behalf of such non-resident in an account maintained with an offshore banking unit in an international financial services center. That's a gift city. That income shall also be exempt from that part. So now this exemption has been extended on that part. So that is what I think the benefit will be there on that part, on this part. So this is a huge opportunity which has been created for all non-resident, which can do portfolio management and can make a lot of income out of there from that part. And income will not be taxed in India and will not be taxed in UAE as well.
Thank you, sir. One online question. Can you give more information on Gift City Ahmedabad. Gift City Ahmedabad. More information as to how exactly we can benefit from it as NRI, whether we'll get benefit in terms of investor or fund manager. This is coming online from Mukesh Shah, Harsh Agarwala. Many members are asking.
I believe I have answered this question, but I will say that yes, if you are a fund manager, you could set up a unit there in the International Finance Service Center, whatever your income as a fund manager, that will also be exempt, including the individual fund manager, that has also been given a concession that his status will not change because of his presence there.
Mukesh ji, exempt. Sir, go ahead with your question. Akhil ji.
Jay, we have one question. Backside.
Yeah, please go on.
Hi, sir. In continuation with the gift city, I just wanted to check whether there are any listed companies which are already set up. And second question is whether the short-term capital gain rate has been reduced.
For which, from where?
For the other
Gift.
No, not for the gift. For the other.
No. See, there is no tinkering with the tax rate this year. Absolutely no tax rate tinkering. Last year also there was no tinkering. So there is no change as regards short-term capital gain arising from any part of the India on that part. And as regards your question whether any listed companies there in Gift City, at present there is no Indian company listed there, set up a shop there in the Gift City. But yes, others company can get listed and that can be traded in the Gift City. See, major challenge is coming up, Indian bond getting listed outside India and income in the hands of the people who trade in Indian bond being exempt. So that issue is still flagged, has not been taken care of. And what the finance minister clarified yesterday in the press conferences, that is under active consideration. So there are certain gaps and loopholes which they are trying to address. Probably it may take time, but Indian bond get also listed outside and any income arising and trading on those bonds will also be exempt. And for your information, expectation is that if this thing happens, India will get about $400 billion of those bonds. That's our expectation working on that.
Yeah, CA Chitranjan, please go.
Hi, sir. Good evening. I was reading one article that income tax is going to be replaced with a expenses tax. So it was a view by some members or some people's view. So I want to know something about from you, sir. Is it going to happen or it is a personal view of some persons which was published in the media? Thank you.
I can answer this question two ways. One, see, we being an accountant, we must appreciate one thing, why we levy taxes. We levy taxes because we need funds to run the country. Now, India project, if you look at this budget, we have projected that 14,30,000 crore rupees will be the expected income tax from company and the individuals in the financial year 22-23. If finance minister takes a call to substitute this income tax with an expenditure tax, I believe the figure of 14,30,000 crore is not going to be changed because this much money is required in any case, 14,30,000. Now, even if you change this figure of income with the expenditure tax, somebody who is paying tax will have to pay tomorrow also. It may happen by changing income tax to expenditure tax. A person who is making 1 crore rupees may end up paying 10 lakh rupees. If that happens, there has to be another person who is paying 10 lakh rupees today will have to pay 1 crore so that the total kitty continues to be 14,30,000 crore rupees. So answer is, it is impossible for any person and any country to, any finance minister to tinker with such system and to replace with in a system which is not a time-tested system. Secondly, globally, income tax is levied across in each country. And Dubai, UAE is the best example. 3 days back, Dubai has also announced that it will levy 9% corporate tax on business profit. So now can India afford to say that we are waiving off income tax and we will be laying expenditure tax? That, I believe, is next to impossible. These are wild thoughts. Sometimes people raise it, but this comes and goes. no so serious thought on this side. My answer is this.
Yes, CA. Anish Mehta, please go ahead with your question.
Jain Saab, namaskar.
Namaskar, Anish.
Sir, I know this is an evolving topic, but again, I would like to ask on crypto. I was watching an interview of Honorable Finance Minister, and she said crypto is not a currency, because a currency can only be regulated by the Reserve Bank or a central bank. So crypto is not a currency, it will be more like a financial asset. And when you see the budget speech, they have taxed it at 30%. But they've also said that if you transfer this crypto, this gift will also be taxed in the hand of recipient. So my question is on a theoretical example, if I buy a crypto, although I have not invested, but if I buy a crypto at 1,000 rupees, and if when I transfer, the mark-to-market value is 2,000. So will I have to pay a tax on this 1,000, difference between 2,000 and 1,000, and the recipient also pays on 2,000, or will it be one tax only?
I will clarify the first issue which you have raised on the currency.
Yeah.
If you permit me for 1 minute, why we need a currency if you can go back to the, I think, civilization. There used to be, earlier part of the civilization, barter transactions. People used to give one goods, maybe wheat for taking, I think may not be sugar or some sugar type product, or maybe some other product, vegetable, etc. And over a period when this became difficult, people started buying things through what we call this bullion, gold, silver, etc., coin, etc. And later on, to facilitate that system, some currency came, and currency came because currency is a medium, so that you need not carry those goods all the time. And that's why there is a central bank which monitors and which regulates that currency, so that you have a confidence in that currency. It does not become what we call an investment. It is only a medium to transfer between two people and to facilitate. Now take a case, currency got substituted when banking got developed. Now instead of giving money, you just write a check and the money get transferred. You do believe that money, but it will get denominated only, but there is no physical transfer at all. Similarly, credit card came up later on in that plastic money which we call later developed. Now digital currency is coming up in that way, but it has to have some government backing or something working, because what you do today, you are not making currency as an investment. In case you are dealing currency as an investment, then it is a security, like a share. You buy a share of a today company, State Bank of India, tomorrow it may become 200 to 400. But you keep currency only that you have taken 200 rupees, it is 200 rupees, it is 500 euro, it is 500 euro or 500 dirham. And tomorrow, same thing you can buy for that value only. So she was right in saying currency is only which is regulated by the central bank. Today, this is not a cryptocurrency, though it is being named, coined as a cryptocurrency. It's a private people who are just working as an investment on that part. Now, coming to your question that if I buy for, say, 10,000 rupees and then it becomes a 20,000 rupees with issue, if you buy at 10,000 rupees, if you sell at 20,000 rupees, then definitely 10,000 rupees is your income, and which she said 30% will be the tax, plus surcharge, etc., which can go up to income. Now, but if you gift to somebody, then it is not a tax, because you are not earning any income. But the recipient, whosoever will receive, if a person is other than your relative, because relative is outside that exemption, 56(2) exemption is there. But if he or she is not related to you and you just give it, the day when you hand it over or transfer to her or him, then whatever is the fair market value, that will be the income in the hand of the recipient, and that will be chargeable to tax at the rate, whatever it is. That's the issue.
There are a few questions from virtual participants, so I will ask JP.
I will take that question. Akhil, please go ahead.
Okay. Jain Saab, please.
Yeah. Good evening,
Yes,
Jain
please.
Saab. My name is Akhil Jain, so I just want to emphasize on that. My question to you, sir, is on crypto assets. Now, gains on crypto assets will be taxed at 30%. Now, what is the current provision in the law for such gains? In the current financial year, for example.
See, this new law will be applicable from 1st April 2022. Now, if I look at the Indian law, as on date, if I make income in India as a resident, I am liable to pay tax at the normal rate. So till 31st March 2022, whatever the income I am making from the cryptocurrency, it will be considered to be as my normal income, and I will be liable to pay tax at the slab in which I fall. If my income is about 10 lakh rupees, then obviously 30% slab will get applicable. If it is less than 10 lakh rupees, then it may be 20% between 5 to 10 lakh rupees. But if it is less than 5 lakh rupees, then it may be totally exempt. Because this new law, which is section 115 BBH, will be effective from 1st April 2022. But that does not mean that this income is exempt today, because every income in the hands of a resident is taxable unless specifically exempted. So there will be, in the absence of any exemption, it will be taxable, but at the normal slab rate.
तो अखिल साहब अभी जो वर्चुअल करेंसी है तो बेच दीजिए सर, थोड़ा तो कम लगेगा, नहीं तो 30% पे करना पड़ेगा।
इनको नहीं लगेगा, ये तो नॉन रेजिडेंट है सर।
नहीं उधर, हाँ वो भी सही है सर, नॉन रेजिडेंट को तो नहीं लगेगा।
Or one thing which I wanted to tell my all friends here is, there is a lot of fear about the last year amendment made, which I explained at the beginning. If you are living in Dubai physically in UAE for 183 days, I don't think there is any challenge to the Indian tax law of section 6(1) amendment which was made as a resident, non-resident. Okay. As I said, TT will prevail. But problem comes up where a person is in India for more than 120 days but has not been in UAE for 183 days or more. Then you are not entitled to take the benefit of the treaty because you are not considered to be resident of UAE under the UAE law.
Right, sir. And I see a lot of people, actually, a lot of NRIs in Dubai, they have already started, applying for tax residency certificate as a, proof of their non-residency. They already started. Now I will request Jayaprakash Agarwal to take few questions from virtual participants.
Thank you, Hariji. Ved ji, first question is on question of law. I mean, what the participant is asking, Ashish Tulshan is saying, why government charges LTCG even when there is STT? So they are already charging STT, why LTCG is getting charged? LTCG was abolished and STT was brought, then why it is getting charged?
I think I must compliment the gentleman who has asked this question. And if you can have a video clip of the back in the year 2006, I have asked this question to the finance minister in the Vigyan Bhavan when he had introduced this. Mr. Chidambaram was the finance minister. In 2004, he introduced this STT. And if you recall his speech, he has said that the constitution maker were wise enough to say that central government has a law to make tax on the transaction because STT is considered to be indirect tax. And in 2006, when he introduced this provision that long-term capital gain will be applicable or it excluded from MAT, then I raised this question because STT has captured that part of taxation which is supposed to be 10% long-term capital gain. Then he said, he has abruptly replied on that part, that tax has to be collected to find out wage and means. And this is the one of the ways and means we have tried to find. I do agree, there is no logic once STT has been levied, but government has the right to levy tax and to collect taxes.
Good evening,
and,
sir.
And one maxim which we use normally in court is, there is no equity in tax. So nobody can say it should be equitable. Taxation and equity are strangers.
Good evening, sir. Thank you for sharing your views on the budget. Now I'm trying to extend the benefit that is being extended through the Gift City or any of such centers that will be established in India. Cryptos are now being regulated, cryptos are now going to be taxed. Let me go a couple of steps further. Supposing an exchange traded fund is launched through the Gift City for cryptos, and there are gains arising out of those exchange traded funds that we trade post 1st April 2022, what will be the effect of taxation from those gains? Thank you.
But you being a non-resident, you are otherwise exempt. You are outside the territory, sir. Whatever you do from Gift City, your income is going to be exempt.
So in a way, I can invest into cryptos through the Gift City and I won't pay any tax.
But that you banking unit should be with you.
Correct, sir.
Because they should also allow, because you cannot do individually, you have to use that fund there. If in case there is a fund established which does it, yes, it is fine, you can do it.
So in a way, this is a loophole that is still not being picked up by the Minister for Finance.
I don't think it is a loophole. You see, when you consider that a part of the country, a center which you have developed is an offshore, then you don't try to impose your law. Then you will short circuit your ambition to make that a global city. See, the idea is in Dubai also you give so many exemptions and so many companies have established base in Dubai or UAE mainly because you give certain concession. And now in case those concessions are being short-circuited, then people will not come. So in case there is a fund set up there or there is a fund manager which do funding or do working on crypto, let him do because the risk and reward is with him only.
Good evening, Ved Jain. My question again, like, on two questions on cryptocurrency. The first question is, will cryptocurrency will have fluctuations like the INR we have up and downs like other currency? And the second question is, there is a restriction like, to repatriate INR outside India. So will the same apply to cryptocurrency as well?
See, the issue is, let me answer the second question first. Yes, as a FEMA, Indian currency being not freely convertible, so you cannot transfer anything outside India unless the FEMA rule or RBI permits. So that condition will continue to be applicable. So it is not that cryptocurrency is something different. Now, I will just give you some basics on that part. When we export from India, the proceeds of that export has to be deposited into bank and it belongs to Reserve Bank of India. You cannot use it for any other purpose. You have to deposit in the bank. The bank, on behalf of the RBI, will take it and give you the money in turn in rupee. So if I export something to, say, from India to Dubai for, say, $1,000 or 1,000 dirhams, now I need to get the proceed. I cannot waive it off also. That 1,000 dirham will come to my bank. RBI will buy it, bank will buy it from me and will pay with the Indian rupee only. Similarly, when I import, I need to import and make the payment, and while you go to RBI, purchase currency, foreign currency, and will remit the amount on that part. So it's an absolutely regulated currency. You cannot leave anything outside, not only the currency, but also the goods also. It's a part on the part. Second part is, on the digital currency, I was happy yesterday when the finance minister said that RBI will be coming with Indian crypto in the rupee, because if the 3-month discussion which has been happening from the last, I think, October, November onward, one must realize cryptocurrency is the future. If any country say that one can live without cryptocurrency, it will be, I think, incorrect. Because as the way say that one can live without banking, we will live in physical cash, nobody can survive. So cryptocurrency is going to be the future. And it is good that Reserve Bank of India is going to come out with a currency with the Indian rupees cryptocurrency, which you can transfer, which you can remit. But the condition and obligation of dealing with the cryptocurrency will exactly be the same, which you have today when you have the money in bank or money in your hand, physical cash.
Okay, the last question, Veji. And since you are here and we know you are expert on taxes, the question is coming straight. You must have heard that corporate tax has been introduced in UAE. From next year, corporate tax at 9% is coming in. The question is coming from Kinjal. She says, what are the tax planning options you will suggest to Indian companies operating out of UAE? Planning measures, considering corporate tax is hitting UAE now.
I believe it is one of the good things which has happened for FCA. See, sometime when such thing comes up, it looks bad, because immediately there may be a cash flow outflow issue may be there. But look at a larger tax perspective with the credibility and the stability. See, UAE all along has been considered as a tax haven country. OECD has been changing these countries like anything. And in India also, the perception has always been that whatever the money comes from UAE, there can be tainted and there can be issues. As against this, Singapore is being considered, because though the tax regime there is also very low, but still considered to be a more stabilized and more credibility. Now, I am of the frankly view that 9% tax in UAE on corporate will help UAE more, and also corporates who are operating in UAE to operate with a credibility and more stability with a 9% tax. Now, coming to the question which you say that what should I suggest on that part? See, there are two models which are working. Presently, many Indian companies have set up shop here and they have a subsidiary company. So whatever income those subsidiary companies earn in UAE, that income is not chargeable to tax. And when you repatriate that income by way of dividend to your parent company, fortunately, India was having section 115 BD under which the tax rate was half, 15% tax rate was there. Now this budget has also abolished that concession. Now any UAE company repatriating any dividend to the parent company in India, now Indian company will be required to pay tax at the normal rate, whatever it may be 25, 25 or 22 plus surcharge 25%, etc. So that may be a dampener for declaring dividend. So my one practical advice is those companies which have set up shop in India and have accumulated profit and they want to evacuate profit, though may not be in the interest of UAE, better to declare dividend before 31st March and repatriate to India, because then the tax rate applicable will be 15% and after 1st April, it will go up 22 or 25, whatever may be the situation on that part. So it's better to evacuate accumulated profit at this point of time. But future from 1st April 2022 onward, there can be different models. One, if you want to insulate your parent company, then you have to have a subsidiary company. But otherwise, it will be advisable to have a branch office rather than have a subsidiary company, because whatever the tax you will pay in UAE as a 9% business profit or corporate tax, you will be eligible to set off that 9% against your tax liability in India. But this will happen on year-to-year basis. As against in subsidiary company, that set off is allowed, you take it only when you declare dividend. So now the choice will be depending upon your profitability, your insulation which you want, and the operation, how big your operations are, that whether you would like to continue with a subsidiary company with a 9% tax, not to repatriate profit to India, or if you are in a position as a listed company, want to declare dividend in India, whatever tax you have paid, you will be entitled to set it off against that tax. So it will depend on each structure, but definitely there will be, I think, restructuring which will be required for many companies which have set up shop in Dubai. But I see economically, it will be a win-win situation, not a loss-making proposition.
Thank you, Jain Saab, for your detailed review and taking up so many